Hello, everybody. This is Predetermined here with Progress Wealth Management. Purpose of today's video is we're going to talk a bit about what stock options are, make sure you have a clear understanding of how they work and what to expect. It should take about 3 minutes of your time. Then we'll be done. So let's get started here. Now, first off, what are stock options? Well, there's two different types of stock options. There's options that give you the right to purchase stock, and there are other options that give you the right to sell stock. Now, both of these give you the right to sell or purchase at a specific price. No matter what that stock does, no matter how high it goes up or how low it falls down, you can get out at that price or get in at that price, which can make those incredibly valuable. So let's imagine it this way. Let's say that you thought to yourself, you know what, Blaine? I want to buy a house sometime in the next 20 years in San Francisco. And I want to buy it for $1 million. That's what I want. And somebody says, you know what? I don't think real estate's going to go up in the next 20 years. I'll take that bet, but in exchange, I'm going to charge you $100,000. That's the risk I'm taking, and that's how much it costs you. 20 years go by, and all of a sudden, houses in San Francisco cost $5 million minimum, and you get to buy them for $1 million, and you only paid $100,000 for the opportunity. You'd be pretty happy about that. You just saved yourself $3.9 million. That's a huge deal. Now, on the other side of things, what if you ended up owning a house in San Francisco? And you said over the next 5 years, I want to be able to sell my house for $1 million, and your house is worth 1.5, right? You think that the real estate market's going to crash. Somebody says, I'll take that bet, but in exchange, I'm going to charge you 50 grand. The real estate market crashes and your house is only worth $500,000. Means you can call that person up you bought that obligation from and say, hey, buy it for $1 million, please. And they say, all right, deal. Now, the second example, that was called a put option. The first example, called call option. They exist, but not real estate. They exist in the stock market. Now, essentially, they give the purchaser the right to decide when they want to buy or when they want to sell. They're not obligated to do anything. They can say, you know what? I don't want to use this. So that's why they call them options. You have the option to use it. Now, the seller on the other side of things, they hope that you're wrong. They're betting that you're wrong. That's why they take that premium. They bet that you're wrong. And they hope that you don't end up making money on this. They get to keep that $50,000 or $100,000 for doing nothing. And of course, who doesn't want to get paid $100 grand to do nothing? Well, they can be used a variety of different ways, but the main way that they're used is to hedge against potential losses in other positions. They're mainly used like insurance for your other stocks that you have. So when you purchase an option, you're purchasing it because you expect there to be a risk that the thing you're hedging against is going to happen. Well, the main benefits of options are, number one is leverage. It doesn't cost you a lot of money to benefit if you're right. Flexibility. You can get in and get out without any issues. Limited risk. The only risk you have is that premium that you paid, $100,000 or $50,000. Typically, it's far less than that. And lastly, the potential tax benefits. Now, if you hold incentive stock options, certain kinds of options, for at least a year before you exercise it, and then one more year before you sell the stock afterwards, pay a much lower tax rate. That could end up being really helpful. Now, the last point I want to bring up is the downsides. Now, the downside, the first one is complexity. Most people don't want to study options contracts on weekends, even professionals, because they get really, really complicated. Figuring out which one to buy and when is nearly impossible. Limited upside potential is the next one. So while options can provide you some leverage, there's also a limit to potential profit, right? If the stock doesn't move in the direction that you expect, then you lose money, and these are worthless. And then lastly is volatility. The cost of these options prices are slightly sensitive to changes in the stock price. This is called basically just volatility. Now, if you want to learn more about this, feel free to join our Facebook group, which is Taxes and Financial Planning Education. Or if you want to learn more about financial planning in general, go to progresswealthmanagement.com. Appreciate your time, everybody. Thank you.